President Trump tweeting about it over the weekend, saying this: "Our relationship with Mexico is getting closer by the hour. Some really good people with both the new and old government and all working closely together. A big trade agreement with Mexico could be happening." Joining me now is Craig Hodges, CEO and co-founder of Hodges Capital Management. Craig, how much of this is baked into the market already? And then we talk about Mexico, but the other slice of NAFTA would be Canada. What do you say?
I think futures is probably a little bit to do with the improved prospects of doing something with Mexico. It's pretty effective that these trade negotiations, or I guess the saber rattling of the negotiations, hurts the market. But at the end of the day, it looks like you get a little better deal for the U.S. I think this is going to be an improved situation for us. So that's positive, and I think that's what the futures are saying this morning.
Hey, Craig, Mitch Rochelle. Obviously, the market is broadly favorable on this, but if we have a NAFTA deal or a part of NAFTA deal with Mexico and Canada's delayed, is there a specific sector or a specific group of stocks that would benefit from the Mexican side of the renegotiation more than the Canadian side?
The ones that hit me are things like Union Pacific that does some things in Mexico. Of course, a lot of the ag and farm type communities will benefit from an improved deal with NAFTA. But here at Hodges Capital, we mostly stay domestic. We mostly just have a smaller company, more of a domestic focus. So nothing specifically I see that's going to be a big beneficiary short term.
So, Craig, I read the research that Mitch Rochelle sent me over the weekend, because, again, that's what he does. He sends me research on monetary policy in the direction of interest rates. But after the Federal Reserve Chair, Jerome Powell, his talk on Friday in Jackson Hole, he defended the push to raise rates. He said, quote, this: "The economy is strong, inflation near our 2% objective, and most people who want a job are finding one. If the strong growth in income and jobs continues, further gradual increases in the target range for the federal funds rate will likely be appropriate." Mitch's research says 2 more rate hikes. I wonder if that is factored in, one in September, then one maybe in December. And I wonder how much pressure, how much of a headwind that could be for stocks here.
I think that's probably what the market has factored in. That's kind of the consensus out there. And 2% is kind of where you want to be, I believe. The market, I think since 1984, with 2% core inflation, between 1% and 3%, has kind of averaged a 21 times multiple. So in that regard, the market's probably somewhat undervalued, considering things. So I think that's kind of consensus, and I think the market can continue to move up in the face of some increased rates from the Fed.
Craig, this is Lee Carter. One of the things that I've been fascinated at is that investor sentiment and polling has been it's been parallel. A lot of the media has said, if Trump were president, the end is near, and that the markets rally after Trump becomes president. There's a lot of people who say tariffs are really, really dangerous, and you look at the markets have really priced it in. There is a point at which, though, people are starting to get anxious and saying we need something to get done, especially with China. This Mexico thing I know has people nervous, but do you see investor sentiment changing, or people getting more anxious now than they have been?
No, I don't. The crazy thing about this advance in the stock market, it's done it in the face of a lot of skepticism. And there still is, that's kind of how markets do. They kind of climb that wall of worry. There's no euphoria out there, that's for sure. And until you see a lot of euphoria and some real ridiculous speculation, I think the market can continue to move up. So this is kind of what's been going on for the last couple of years, moving up in kind of the face of skepticism, if you will.
Mitch, Craig said the market's undervalued. Do you agree?
What's interesting is you look at the trajectory of corporate earnings. I would agree with that. My concern is that we don't see a continuation of that earnings growth because of the potentiality of rising interest rates and also the very strong dollar. Multinationals have to contend with a stronger dollar. So I worry long term about the ability to continue to have these 20% year-over-year earnings growth.
Yeah, how do you allocate your money here, Craig? To Mitch's point, I will note that the Russell 2000 also hit an all-time high on Friday, and those stocks, those companies seen as being the most immune from the rising dollar, smaller, more domestic-oriented businesses, and also maybe immune from the trade fights that we're waging with not just China and Mexico, but Canada and Europe.
That's a good point. A lot of the smaller domestic companies don't deal with a lot of that. But, you know, the market, to me, looks fairly undervalued. If, you know, 165 in the S&P earnings this year, that's 17 times. And I think most people haven't raised their estimates yet next year for 180. That's 15.5 or 0.7 times. You know, historically, that's a pretty low number. So the thing about the market, there's parts of the market that are very expensive. Where I see to allocate money is the stuff that's lagged, the industrials, the airlines, the materials, and, you know, a lot of those type of things. A lot of them are trading at, you know, towards their 52-week lows. And to me, that's the part of the market that I would focus on.
Well, Craig, before we go, I do want to talk about the trade tensions, headway being made in terms of our negotiations with Mexico. But you heard concerns at the Federal Reserve gathering at Jackson Hole on Friday. And even though the retailers' numbers from a Walmart to a Target, even a Nordstrom, were so good, you still had commentary on those earnings calls from many of these retailers struggling to try and figure out how this plays out. Where are they going to source their goods, making sure that they have a broad diversification in their manufacturing base. And so at what point do investors start punishing those companies that would be hurt by heightened trade tensions, not just ones that are waning, so to speak?
I don't see that really being a factor. I think the biggest factor is the consumer. And the consumer is as healthy as we've seen him in years. In fact, you look at consumer debt.
Or her, Craig.
Or her, yeah. Thank you.
You're welcome.
Or her. But no, I mean, look at debt. Look at debt. It's very, very low historically. And, you know, you're seeing wage growth, and you're seeing a little more optimism in as far as prospects for jobs. So I think we're in a really good position as far as the consumer goes. And I think that there's a lot of cross currents because of the Amazon effect, and a lot of retailers are struggling, especially mall-based retailers. But, you know, they're adapting, and the consumer's as strong as I've seen it in decades.
Craig, good to see you. Thank you, sir, for looking at the world for us. Craig Hodges.